On April 1, 2026, the South African economy will absorb one of the sharpest cost increases in its history. This table shows the precise magnitude of the incoming adjustments. Inland consumers are projected to see petrol 95 jump by 6 rand and 3 cents per liter, while wholesale diesel 0.005% surges by 10 rand and 21 cents. This 29% single-month surge shatters the all-time historical records set in July 2022. The R29 price point reflects the mechanical output of a fixed regulatory architecture. To trace how we arrive at this 29 rand per liter reality, we must deconstruct 3 independent macroeconomic variables: geopolitical conflict, currency depreciation, and domestic tax policy. In late February and throughout the month of March 2026, military hostilities escalated between the United States, Israel, and Iran. The conflict quickly threatened the Strait of Hormuz, a maritime choke point that normally handles 20 million barrels of oil every day, roughly 1/5 of global consumption. The immediate physical consequence was the paralysis of regional maritime logistics. Approximately 200 tankers carrying crude oil and liquefied natural gas were forced to either drop anchor or divert entirely to avoid the combat zone. Analysts estimate these disruptions effectively removed 11 million barrels per day from the active global supply chain. This supply-demand imbalance injected an extreme risk premium into the market, driving Brent crude from a $69 average in February to intraday spikes of $120 per barrel by late March. This Middle Eastern conflict acts as the primary ignition source for the mathematics determining South African pump prices. South Africa operates under a structural energy constraint, a lack of domestic crude reserves, and a steady decline in local refining capacity. As a net importer of finished petroleum products, the domestic market relies on a regulated mechanism known as the Basic Fuel Price, or BFP. This formula represents the daily cost of importing a liter of refined fuel to South Africa, accounting for product price, ocean leakage, and stock financing. The Central Energy Fund tracks this against the fixed domestic price. Higher import costs create an under-recovery. An under-recovery means the oil industry is selling at a loss, a deficit that is recovered by increasing the consumer price on the first Wednesday of the following month. The formula operates without friction. A logistical disruption on the other side of the planet is mathematically guaranteed to hit the South African consumer. When Brent crude reached $120 a barrel in March, that cost entered the BFP equation. Inside the bracket, the free on-board value, which tracks the international product price, rises to match the inflated $120 commodity cost. Because massive tanker fleets are avoiding the Strait of Hormuz and detouring around the Cape of Good Hope, the longer voyage times drastically inflate the freight variable. Compounding this, extreme cold weather in the Northern Hemisphere drove up the demand for heating fuels, creating tighter global supplies, specifically for middle distillates like diesel. The free on-board and freight variables alone generated record-breaking under-recoveries throughout March, setting the baseline for the current crisis. Yet there is one final variable sitting outside the brackets: the exchange rate. As a high-beta emerging market currency, the South African rand is extremely sensitive to shifts in global risk sentiment. When conflict escalated in the Middle East, international investors moved capital into safe havens like the US dollar, exiting emerging markets. This capital flight caused the rand to weaken from its February average of R$16 to trade in a volatile range approaching R$17 against the dollar. The formula follows a strict rule of thumb. For every 10-cent depreciation in the exchange rate, the domestic fuel price shifts by 6 to 10 cents per liter. The weak exchange rate acts as a multiplier. South Africa is forced to pay for record-high dollar-denominated oil with a depreciated domestic currency. The third component of the April shock is entirely independent of international markets. It stems from the 2026 national budget. After 3 consecutive years of freezing tax hikes, the government is reintroducing inflation-linked increases to domestic fuel levies, adding a combined 21 cents per liter across petrol and diesel. To manage these spikes, the industry uses the Slate account, a self-adjusting ledger meant to buffer extreme under-recoveries before they reach the consumer. However, if the government attempts to subsidize the April shock by passing on only 6 rand instead of the full 10 rand for diesel, the unpaid balance is recorded as massive debt inside the Slate account. Suppressing the mathematics in April only guarantees that a Slate levy will be added in May, transforming a sharp price spike into a sustained high-cost plateau. Moving from the abstract formula to physical reality, the output is a wholesale diesel price exceeding 28 Rand 80 cents per liter inlined. For the agricultural sector, this surge coincides with critical planting and harvesting cycles, directly inflating the cost of mechanization and irrigation. The anticipation of a 10 Rand hike triggered commercial stockpiling. By late March, stations in the Western Cape were rationing diesel to 50 liters per customer to prevent total stockouts. In road freight, where fuel accounts for up to 50% of total operating expenses, logistics companies are already implementing emergency fuel surcharges. In the urban gig economy, a 6 Rand increase in petrol erases the daily profit margins of ride-hailing drivers, rendering many trips entirely unprofitable. When diesel spikes by over 10 Rand in a single month, the shock transmits into operational crises across every sector of the real economy. This diagram tracks how an input cost of R28.81 for diesel flows downstream through agricultural expenses and logistics surcharges, embedding itself in the consumer price index. These compound costs are expected to drive headline inflation from 3.5 toward 5.0%. Inflation of this magnitude places immense pressure on the South African Reserve Bank to either maintain or hike interest rates, compounding the financial strain on households holding mortgage and personal debt. The April adjustment exposes a structural vulnerability, a total reliance on imported refined products and a dollar-denominated pricing model. Until South Africa rebuilds its sovereign refining capacity or accelerates a transition to alternative energies, its domestic economy remains captive to the deterministic mathematics of global volatility.